As the European Central Bank grapples with the intricate task of taming inflation while preserving economic growth, the thorny issue of wage dynamics across the euro area has emerged as a formidable challenge. In a region where every nation's labor market operates under its own idiosyncratic set of rules and norms, crafting a unified monetary policy response is akin to navigating a labyrinth of contrasts and contradictions. The data from the bloc's heavyweight economies paint a picture of uneven wage pressures, with Germany standing out as a particularly vexing case. The legacy of past wage deals, amplified by one-off payments, has driven salaries sharply higher in Europe's economic powerhouse. This phenomenon, coupled with the potential for companies to pass on rising costs to consumers, threatens to prolong inflationary pressures beyond the ECB's 2% target. Policymakers in Frankfurt are unlikely to find solace in the moderation witnessed elsewhere in the region. The temptation to swiftly follow June's anticipated deposit rate reduction with another bold move the subsequent month is rapidly diminishing. This cautious stance is reinforced by the surprisingly robust economic expansion across the 20-nation bloc, even as inflation retreats toward the desired level. For the ECB, strong German wage growth will be another reason to move very carefully with rate cuts, even if wage growth in most other eurozone countries is much more muted, remarked Carsten Brzeski, an economist at ING. His assessment encapsulates the ECB's unenviable position, caught between the gravitational pull of disparate wage dynamics and the imperative to maintain price stability. Across the channel, a patchwork of wage-setting mechanisms further complicates the picture. While Belgian contracts are directly tied to inflation, German and Italian workers must navigate periodic bargaining rounds that determine compensation over multi-year periods. France, on the other hand, boasts a more flexible system, with salaries in numerous sectors agreed upon annually. Amid this mosaic of labor market complexities, estimates of first-quarter wage growth vary considerably. ING's Brzeski envisions an acceleration to roughly 5%, while Nomura analysts anticipate steady growth of 4.5%. Barclays economists, meanwhile, project a slowdown to around 4%, citing indicators that suggest deceleration is afoot. There are some indicators from the labor market that suggest wage growth in the euro area is decelerating, said Barclays economist Christian Keller. This should contribute to further disinflation, which is already more pronounced than in the US. However, the sanguine voices are counterbalanced by those who point to the continent's tight labor market, which has weathered the shallow recession of late 2023 with remarkable resilience. Germany bore witness to a series of transport strikes this year, and construction workers seeking better pay are poised to join the fray with their first walkout in 17 years. The undersupply of labor will put upward pressure on wages, cautioned Holger Schmieding, chief economist at Berenberg. We therefore don't project nominal wage growth to settle below 4% on a sustained basis. As the ECB anxiously awaits the official data on negotiated wages, slated for May 23, and Eurostat's closely watched gauge of first-quarter pay growth on June 7, a day after the next rate decision, it has sought to illuminate the path forward through its own, newly developed trackers of euro area pay. According to the account of April's policy meeting, these trackers continued to show signs of easing. However, rate setters have also underscored the importance of corporate profits absorbing a portion of the higher labor costs, following years of margin expansion. The extent to which this absorption occurs in the pivotal services sector remains uncertain, the ECB's policy account revealed, adding, while progress had been seen, monitoring the triangle between wages, productivity growth, and profits continued to be key. As the wage conundrum unfolds, the ECB finds itself at the epicenter of a multifaceted challenge, navigating the intricate interplay between wage dynamics, productivity, profits, and the ever-elusive goal of price stability. In this intricate dance, every step must be carefully calibrated, lest the misstep ripple across the delicate fabric of the euro area's economies. For the millions of workers and businesses across the continent, the ECB's ability to strike the right balance will have profound implications. It is a high-stakes endeavor, one that demands a deft touch and an unwavering commitment to prudence, even in the face of seemingly conflicting pressures. As the curtain rises on this act of economic policymaking, all eyes are on Frankfurt, where the performance will determine not only the trajectory of wages and prices, but the very fate of the euro area's hard-won economic prosperity.